If you earn $1 more than 400% of the federal poverty level, then you do not qualify for ACA subsidies. So for a single individual, that's like 62,000, and for a married couple, that's somewhere between 84 to 120.
Peter, so good to see you. Welcome back, everyone. Today we're going to talk about the ACA cliff, the $1 income mistake that could cost you thousands in health insurance. One of the biggest surprises people face when retiring early has nothing to do with investments. It's actually healthcare. And starting this year in 2026, a little known rule under the Affordable Care Act is creating a really shocking outcome. In some cases, earning just one extra dollar of income could trigger tens of thousands of dollars in additional premium costs. Peter, can you explain this for us? What's changed?
Well, so a provision of the Affordable Care Act expired.
Okay.
And I think that they play this game with legislation in Washington where they put these expirations on certain things so that the next person can say, well, I didn't do that. That was already part of the law that went away. Or they could blame it on the next guy and say, well, look what he did to healthcare premiums. But regardless of the game, the provision expired where we had this gradual increase of income and correlating subsidies that went along with it. And now it is a hard cliff. If you earn $1 more than 400% of the federal poverty level, then you do not qualify for ACA subsidies. So for a single individual, that's like 62,000, and for a married couple, that's somewhere between 84 to 128,000 of income, depending on how they're filing and their situation. But basically, you earn $1 more than that, and you no longer qualify for those subsidies. You have hit the ACA subsidy cliff, and you will be paying full price for your health insurance, which is expensive.
Yikes. Okay. So then to see kind of what that cliff looks like, here it is. As you mentioned, the ACA subsidy cliff was removed. What does this mean then for people who need healthcare before they are eligible for Medicare, which, as we know, starts at 65?
Right. Or are not covered under a workplace plan. Right. So
Yes.
a lot of times who I am talking to, who I am dealing with as we are planning and mapping out retirement, we are talking about maybe a pre-Medicare retirement age and how to cover healthcare costs in the donut hole. But it could be anywhere along the way of your progress. If you are not covered by some kind of workplace, or for younger folks, even on their parents' healthcare plan, that means that you will be paying full price for health insurance. And for married couples, who are thinking of early retirement, maybe you waited until 59 and a half or 60 or 62, you should have an expectation of $3,000 to maybe $3,600 a month. I'm seeing anywhere from $30,000 to $40,000 a year that we need to budget for health insurance premiums alone. And I'm not even talking about copays and deductibles and out-of-pocket expenses. I'm talking about the premiums for the insurance coverage. Could be anywhere from $30,000 to $40,000 if you are in that donut hole.
Okay, it really is kind of shocking to look at what used to be a nice little curve there, jump right up. So
yep, no, it jumps right up, and it hits people very hard. People are surprised by this, especially because for the last several years, I can't remember exactly when the ACA went into effect, but we've had this gradual increase of income that we still had subsidies. And then December 31st, 2025, that provision expired, and the cliff went into full effect January 1st, 2026.
I think the buffer was put into place around COVID.
Yeah.
Okay. So Peter, talk me through who gets hit the hardest with this.
Well, I think anyone who is pre-Medicare age, anyone who is $1 over this limit is getting hit pretty hard, unfortunately. And it is something that we do need to think about and plan and prepare for whenever possible. I don't think anyone is going to argue against the fact that healthcare in this country is a broken system, right? So I think that at some point in time, we do revisit this. I hope we do and figure out some other solution. I don't know if any of the extreme proposals on either side of going universal health care for all or completely private pay, let competition sort this whole thing out. I don't think that either of those like make complete sense or will be a reasonable solution, but there's got to be some reconciliation here and meeting in the middle. Otherwise, those bureaucrats that make the laws keep on with their private health insurance coverage, and us norms in general society have to deal with this huge out-of-pocket expense, which, by the way, is prohibitive from younger people making the retirement planning progress that they should otherwise be making.
Right. I always like to say our healthcare system is great until you're sick.
Right. Yeah. Or in this case, Erin, even if you're not. Again, these are not the sick payments anymore. Broken. These are the payments that you make just to have the coverage in case you get sick.
Yeah. So you touched on proactive planning being key here. What can people do now to avoid this income trap?
Be aware of this and plan ahead. If you are planning on retiring early, HSAs, Roths, non-qualified assets, even certain strategies with loans from life insurance might be reasonable strategies to avoid your income on the books going over that cliff. And, with Roth withdrawals, like you're seeing with the little Mr. Piggy Bank there on the screen, they go in and you pay taxes on those up front, and then you can withdraw those dollars and all of the gains that they've made tax-free, and they don't go into the equation for possibly putting you over this ACA income subsidy cliff. So anything that is going to basically be tax-free income above the fold, above the line on your tax return would be a reasonable solution here. Non-qualified assets that maybe you can just harvest capital gains or have a piggy bank there that you're removing funds that you've already paid tax on from are going to be, I think, our only solution here, at least for the foreseeable future, until something gets addressed here.
Mm-hmm. And just real quick, I did have that HSA visual that I threw up without you knowing, but explain the tax benefits of that, please.
Yeah, so it's triple tax free. You put the money in, you get a deduction, it grows tax deferred, and then you can withdraw it for qualifying healthcare expenses and not pay tax on it. So it is a fantastic opportunity there
for everyone.
And this is why I think it's so important for everyone to have a plan that incorporates not only just like what is your investment rate of return and how do you have access to the market, but how are you going to create income in retirement, how it is going to be taxed, and how your healthcare expenses are going to be impacted.
Mm-hmm. So just to say it again, proactive planning is critical. Income, not just about taxes anymore. This is going to directly affect your healthcare, especially for those in our audience who want to retire early.
Yeah, in that donut hole, but even thereafter, Erin, I mean, a lot of people don't realize that your Medicare premiums, even once you are on Medicare, are also income tested, IRMA, income related monthly adjustment amount. And if you've got a large IRA and have to take your RMDs, that might trigger IRMA and your healthcare premiums for Medicare to go up exponentially more than they need to. So all along the way, how much you pay for healthcare is now a byproduct of how much income you earn or have. And we need to look at that and strategize carefully on how to control not only the taxes, generate the income you need, control the taxes, but also control the impacts that income is going to have on your healthcare premiums before Medicare age and lasting for the duration of your life, even after Medicare age.
Right. Yeah. It's wild. It's almost like an 8-point scale, like adding onto this plate and moving something over here. There's probably a better analogy that I could come up with.
And I fear that the government is figuring out that the subsidy systems, the trust funds that are supported by these income related penalties are the ones that are doing the best. And they did not have to actually enact a total new tax code for that. They just tacked this on to us. They're going to look at that and say, well, it's working over here. Why don't we try this in other places? Is my fear as I sort of look forward down the road. And so all of that to me just continues to indicate that now is the optimal time to do some tax and income and healthcare management planning, and why we put together for our clients that optimized retirement plan at Richon.
Yeah. Prepare for the worst. Always good advice. Peter, if somebody would like to sit down with you, either they would like to retire early or just talk about a plan for healthcare and retirement, which, as you mentioned, is so important. What's the best way to reach you?
Give me a call, 919-300-5886, 919-300-5886. We have professionals on our network our team of network that do nothing but help people with Medicare, if that is where you are at in your progress, do nothing but help people with health insurance if you are pre-Medicare age. And we coordinate efforts right there side by side with them to make sure that the finances are working congruently to give you the best prices that we can possibly achieve for you for the coverage that you need. So again, that's part of the optimized retirement planning process, bringing all the pieces of the puzzle together. Give me a call if you'd like to just have a chat, conversation, have questions about this, or if you would like to get your optimized retirement plan put together. No cost, no obligation. It is a courtesy service that we offer. So Peter Richon, Richon Planning, peter@richonplanning.com by email. RichonPlanning.com is the website you can visit, or 919-300-5886, 919-300-5886. And just text your name to that number too. You can get in touch that way.
Great. Peter, thank you.
All right. Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.